Welcome to Good Money Moves, the show where we share financial tips and advice to help you feel financially empowered. I'm Jenna Taubel, and with me today is Jordan Kaehler of First Alliance Credit Union, our loan portfolio manager here at the credit union. And today we are digging into an important topic that I think everyone should know about, and that is auto loans. We all have cars, we need to drive around, and how you finance that, it's an auto loan. So that's what we're digging into today. But before we dive deep into the topic, Jordan, why don't you just share a little bit about yourself and your role here at the credit union?
Yeah, so I'm the loan portfolio manager, and I keep a close eye on our interest rates to make sure that we're not outpricing ourselves, or how we have too high rates, too low rates. I oversee our underwriting team for consumer, which would be for car loans, home equity loans, credit cards, things like that. And I also oversee our business credit analyst, or commercial credit analyst, for essentially an underwriter for business loans.
Awesome.
That's most of what I do anyway.
Yeah. We all wear lots of hats here at the credit union. Yeah. So awesome. Well, thanks for that introduction. Let's just start our conversation at the most basic level possible. Mm-hmm. What is an auto loan?
Yeah. So an auto loan is a loan with a fixed rate, a fixed term, and it's secured by your vehicle. So what that means is essentially if you default on your loan, which we know you won't, then it could be repossessed or taken from you.
Sure. So when you say the word secured, it just means that the vehicle is the piece of collateral, the asset that you own that is saying, if in some way, shape, or form I am unable to make this payment, I'm going to basically forfeit this piece of collateral that I have in exchange for a lower rate.
Yes.
Okay.
Yep.
Okay.
Yep, exactly.
So, well, rates, right? Let's talk about maybe some of the other factors, including digging a little bit deeper into interest rates and car loans too. But what other factors make up an auto loan payment? How is that factored? How does that come to be?
Yeah, so there's a few different things that go into a car loan payment and what comes up with that. The first thing is going to be how much of a loan do you need? Because the higher the loan, essentially the higher your payment. Another factor that goes into what your payment looks like is going to be the term of the loan. And when we say term, financial institutions typically use months. So you've got usually 12 months, 24 months, 36, essentially goes by 1 year at a time.
Sure.
And generally, the longer your term or the more months or years your loan is, you'll see a higher interest rate with that. And interest rate can also play into what your payment looks like too. So the higher your interest rate, the higher your payment may be relative to, say, somebody else who maybe has a really good credit score versus maybe someone who has what we call colorful credit. And then the last thing is going to be your credit score, which we've talked about previously. The lower your credit score is, generally, the higher your interest rate will be.
Okay. If
that makes sense. So all of those things collectively will make up what your monthly payment looks like on a car loan.
So if I'm going to recap what you just said, because you threw a lot of information.
Yes.
So essentially, there's kind of three main factors that determine what your payment's going to be. It sounds like your loan balance, so the amount that you're going to borrow, the length of time that you have the loan for, and you mentioned terms like 12 months or 60 months, which would be like 5 years. So the length of time that you have your loan, and then the interest rate that you're qualifying for is another factor. And if you have what's considered a good credit score, your interest rate will be lower than if you had a higher score where your interest rate would be higher, and then thus you would have a higher loan payment potentially because of that as well.
Yeah.
Did I summarize that correctly?
Yep, pretty
Excellent.
much. Yep.
Excellent. So let's talk a little bit more about the loan term, the length of time that you have it. Is there maybe a pros and cons between choosing a shorter term versus a longer term loan? Because the longer you have your loan, the smaller your payment would essentially be. But there's, we offer 12-month terms, so why do we offer that if your payment's going to be higher? What's the benefit to having a shorter term loan?
Yeah, and that just all depends on what your needs are. The benefit to having a shorter term loan, is that you will be out of debt sooner. Nobody wants to be married to a payment for 6 to 7 years. If you have a mortgage, you're married to that payment for 30, So as long as you're okay with having a higher payment, you will get out of debt sooner. Now, again, with the extended terms, you're having those lower payments. Sometimes, I mean, a lot of people live paycheck to paycheck, and so sometimes you need to have that extended term in order to have a reliable means of transportation to get to work so you can make your payment and put groceries on your table. So it all depends on everybody's scenario as to what kind of a term would make sense, but that's essentially the shorter the term, the sooner you'll get out of debt and you won't have a payment anymore.
Awesome. So if you can afford the payment at that shorter term, it's actually probably better to go forward with that, even though your payment might feel smaller over that long term. Really, it's ideal to have that shorter term.
Yeah. And another reason for that is because vehicles over time do what's called depreciate or decrease in value. And so if if you don't have much for a down payment, and say you're upside down because the dealer had to wrap in, say, the cost of taxes for the purchase, the title fees, any, tags or anything like that, you'll kind of start what's called upside down, where you might owe more than what it's worth. And so if your loan depreciates or decreases, or if your car depreciates or decreases in value faster than your loan pays down, you may be in a position where you have what's called negative equity, and that gap could increase greater over time. So you'll be faced with having a lot to roll into, say, your next car loan if you need one. So when you have a shorter term, you're going to avoid the risk, or you'll have less risk of facing that scenario I just described.
That is a great point. I would have never thought about that, but you're right. With how quickly cars depreciate, and especially when car pricing has been kind of inflated and then it came down a little bit and it's still not all the way back down from where it was before, you could very easily end up in that scenario pretty quickly, it sounds like. Well, and you mentioned something else that I wanted to dig into in our conversation, and that is, you mentioned like other fees and taxes and things that go along with buying a car that could be potentially rolled into an auto loan. Can you talk a little bit more about what some of those are? And, I know that some financial institutions charge things like application fees, whereas, the credit union currently doesn't charge anything like that. So are there other fees or taxes that our listeners should really know about when they're thinking about moving forward with an auto loan?
Yeah, so as for fees, most fees from the dealer are pretty standard and may be required from the state. So you need to pay sales tax. That's going to be written into the document that you sign called a purchase agreement. The breakdown on all this stuff should be on the purchase agreement. So again, that's your taxes. Those have to be paid. You're going to have title fees. So like the dealer will prepare what's called a grant application, or a title application, and pretty much that goes up to the state so you can get your title. Minnesota, they actually mail you the title. Some states the creditor may hold on to the title till the loan's paid. But Minnesota, the title gets sent to the person who has the car. Sure. And then dealers may throw in some stuff like, you may see like an undercoat where they might prevent rust or something like that.
Sure.
So, there's things like that.
Like
that
maintenance
a dealer can
type
roll in.
stuff?
Yeah.
Okay.
Some dealers have like maintenance packages that they might roll into, or, come to us if you want your car detailed or something,
Sure.
and however many times per year that's included in this. So they may include a variety of things in there. Unrelated to taxes and title stuff, there are what's called ancillary products that the dealer may offer. That undercoating may be one of them. Another one that a dealer may offer is something called GAP. We also have GAP. It covers a tremendous amount, and it's like half the cost of most dealers.
Okay.
So you can save a lot of money there by just coming and talking to us. I think that, being equipped with information is the most important thing when buying a vehicle. Dealers may also offer warranties. We also offer warranties. Well, they call them service contracts. They're service contracts, warranties. They're pretty much the same thing.
Sure.
So those are kind of the two most common things that a dealer will attempt to sell to you is a warranty and GAP.
And what does GAP insurance do?
Yeah, so GAP, essentially, like in that scenario where I described about the negative equity and kind of being upside down over time, at a high level, what GAP, we call it Guaranteed Asset Protection.
Okay. So it's an acronym.
Yeah.
Okay.
Yep. And so what it does is, let's say you're driving down the road and you get your vehicle totaled. Insurance company says your car's worth $15,000, but you owe $17,000. Essentially, when insurance pays out your $15,000 to the loan, GAP will cover that $2,000 difference.
Okay.
Our GAP also has some other benefits in addition to what most dealerships will offer, in that, like, if you have a GAP claim that gets paid and you finance the next vehicle with us within a certain amount of time, I forget what it is, they'll actually give you $1,000 to apply to your next loan, again, provided it's financed with us, to pay down $1,000 off your loan balance.
So they're kind of helping you out with a down payment almost? Is kind of...
Indirectly, yeah.
Indirectly?
Yep.
Okay. Okay.
Yep.
Interesting.
Yeah.
So lots to think about
Yeah.
when it comes to potential add-ons, either from the dealership where you're buying the car, or, you know, through the credit union. Lots of options to just get the best bang for your buck a little bit, or, you know, just be aware of it should they be offered to you, so you can kind of look into that and decide ahead of time if that's something you feel like you need.
That's right.
But bringing up that $1,000, that example, you know, that makes me think about down payments in general. Is a down payment something you have to have in order to purchase a vehicle or to get a loan for a vehicle? Or, you know, what is the kind of best case scenario for someone when it comes to having a down payment for a vehicle loan?
Yeah, so having a down payment will help improve chances of credit approval in general, generally speaking. There's a lot of different factors that go into it, but it's not always a requirement to have. I think things to be considered with that are kind of like what we've already touched on. The more your down payment is, the less you may have to worry about having negative equity in the long run. You know, you talk about the factors that influence what someone's payment is. It's the loan amount. Having a down payment will decrease your loan amount. Some places, I think, I don't know if down payment lowers interest rate or not, but that could be something. So down payment, long story short, down payment may not be required, but it can help toward an approval.
Sure. So is there, you know, like with mortgages, they always throw out the number, oh, you should have 20% down, you know. Is there like a magic number for auto loans, or is it, you know, a little bit is better than nothing?
Yeah, there's no real magic number per se. I mean, I'm of the opinion that the higher down payment you have, the lower of a loan you need, so the more flexible repayment terms you can have to make it more affordable and not run the risk of being upside down.
Sure.
But there really is no magic number per se that has to do with the down payment. I know with our underwriting team here, it's seeing a down payment certainly does help. It shows some kind of commitment to be like, yes, I'm putting some of my own money into purchasing this vehicle.
Sure.
And it shows kind of a commitment. And it also shows, you know, like if, say, even if it's $500, it shows that you were able to save $500. You know, if you're looking at a payment of $300, you know, it shows that you were able to save that to put forward toward the purchase of the vehicle.
Sure. So really a down payment is beneficial in a couple ways, it sounds like. So it's beneficial, and it can lower the total amount that you need to borrow, which then essentially lowers your overall payment month to month, which is helpful. And then I think the second kind of big point that you made was that equity in the vehicle, you're less likely to be, you know, quote unquote upside down in your payment in the long run. So awesome. What that then kind of leads me to a little bit is back to credit scores, and we kind of talked a little bit about it, but I want to talk a little bit more about how credit scores impact your auto loan a little bit more. Like we talked about the interest rates and how if you have that higher credit score, you'll have that lower interest rate. If you have that lower credit score, you're going to have that higher interest rate. Yep. When we're looking at auto loans, let's just talk to me a little bit more about how all of that works and how you guys look at that. Yeah,
so at First Alliance, let me back up. A lot of places will put you in a box and say, if your credit score isn't here, sorry, you don't check that box, you can't get the loan. At First Alliance, someone's credit score, all we do is that just determines their interest rate. It's not, someone's credit score in and of itself is not going to determine if you get the loan or if you don't get the loan.
Okay.
But yeah, that like you said, you hit it kind of on the head. The higher your credit score, the lower your interest rate. The lower your credit score, the higher your interest rate. And with the higher interest rate may come a higher payment, and you're paying more to finance that loan relative to someone who has a higher credit score.
Okay.
Just in total interest costs.
Yeah. So if somebody, let's say somebody comes in, and I'm sure you probably see this quite frequently. Somebody does come in, they maybe don't have a credit score because they've never really taken on debt before, or they have a low credit score because they've just had financial troubles.
Yeah.
Maybe they're not qualified in exactly how they submitted their application, but I'm sure there's kind of other solutions out there to get someone qualified for an auto loan if maybe them by themselves don't qualify. Can you talk a little bit about what those options look like for someone?
Yeah. So what you can do is you can get somebody who's called a cosigner, which is essentially somebody who agrees, like in the event that for whatever reason you may not be able to pay or you need some help or something, the cosigner has essentially volunteered to step in and make your payment on your behalf in the event that you're not able to. Okay. And so that can add a lot of strength in lieu of a down payment or something, because like I said earlier, a lot of people do live paycheck to paycheck, and the ability to come up with a down payment is very difficult. And so you can have that cosigner, and that can help to get your chances of approval. And also, I don't know that every place does it like what we do, but we will price our loan off of the higher of the two credit scores.
Okay.
So let's say that you've got a 640 for a credit score, but you've got a cosigner who's a 740. That 740 cosigner is going to qualify you for our lower interest rates here, or lowest interest rates here. So it can, one, help your chances of approval, and it can also decrease the interest rate that you would otherwise get individually in the event that you have a cosigner. In the event that you don't have a cosigner, we can certainly set you up for like an action plan. In that, say maybe right now is not the time for a car loan from a credit approval perspective.
Sure.
But we can help with getting a credit builder loan established. And with that, you will establish positive payment history with First Alliance, and then at maturity, that loan essentially funds what's called a certificate of deposit. And that certificate of deposit, once the loan matures, the CD is what the acronym for it, will be mature. And then you can take the funds from that and use it as down payment. And throughout the term of that, you've established positive payment history with us. So you'll show that you have the ability and intent to make the payment.
Sure. And
then you'll have down payment to individually. It takes a little time, but it's worth it if you're able to wait that way.
Awesome. So, yeah, it sounds like just because you have a low credit score, there are still options out there to get access to the financing that you need, especially for something as important as having access to transportation. So that's awesome. I have one last question for you before we wrap up today, because we're coming up on time.
All right.
I want to talk about pre-approvals and how important is it for a borrower to get pre-approved for a car loan before they go shopping?
In my opinion, I think it's very important to get your pre-approval from your financial institution in advance of going and looking for a vehicle at the dealership. The reason that I think that it's important is because specifically at First Alliance, we look out for our members and the best interests of our members. And I can't say this for all dealers, but a lot of dealers are incentivized by commissions. And so they're out to make the biggest sale they can, generally. And we're out for your best interests. So what you might find is, say you get a pre-approval for, say, a $20,000 car loan here, and we've worked with you, you've established what payment you're hoping for is, and when you go to the dealer, they may push you into like a flashy vehicle that's maybe $25,000 or $26,000, which from a monthly payment perspective, that increased amount is going to increase your payment, and you don't want to have buyer's remorse from that. And so working with us can help to prevent any of those things, where we really are looking out for the member's best interest. Yeah,
so pre-approval from the credit union sounds like it just helps you stay within the budget that you're comfortable with, and it kind of gives you that piece of paper to bring to the dealer and say, this is the amount I can get approved for, help me find something in this range. Yeah. And kind of just gives you that. It's like we're there with you at the dealer a little bit. Yeah.
What I always tell our lenders to tell our members is, to a dealership, say, I'm here to buy a car, not get a loan.
Yeah. That's perfect.
Yep.
And we'll leave it at that. Thank you so much for joining us today, Jordan. As always, it's great to have you on the show with us. Of course. Before you go, please take a moment to subscribe to Good Money Moves so you never miss the important financial tips and advice that we're sharing. And if you want to learn more about auto loans or get pre-approved for an auto loan, you can visit our website at firstalliancecu.com. And until next time, this has been Good Money Moves, and stay financially empowered.